Look, I'm not one to sound alarms unnecessarily. I've been analyzing precious metals markets for years, and I've seen plenty of false warnings come and go. But what's happening right now with your cash sitting in the bank? This is different. This is urgent. And if you don't understand what's unfolding in the next few minutes, you could watch decades of your hard-earned savings evaporate. Let me paint you a picture of what's actually happening to your money right now, this very second, while it sits in your checking or savings account. You think it's safe. You think it's protected. The FDIC insures it, right? But here's what they don't tell you. Your cash is being systematically devalued at a rate we haven't seen since the 1970s, and the mechanisms protecting your purchasing power are breaking down in real time. I want you to think about something. In 2020, the Federal Reserve's balance sheet was around $4.5 trillion. Today, we're pushing $8 trillion. That's not just a number on a screen. That's the dilution of every single dollar you own. When the money supply expands that dramatically, your savings don't just lose value slowly over time. They hemorrhage purchasing power at an accelerating rate. But here's where it gets really interesting. And this is what keeps me up at night. The traditional relationship between interest rates and inflation has completely broken down. Right now, even with rates where they are, real interest rates, when you account for actual inflation, are deeply negative. What does that mean for you? It means your bank is paying you maybe 4 or 5% on a high-yield savings account, while your actual cost of living is increasing by 8, 10, maybe 12% depending on what you're buying. You're losing ground every single day. Now I know what you're thinking. But the Fed says inflation is coming down. The numbers are improving. Let me tell you about those numbers. The Consumer Price Index, the CPI that everyone watches, has been systematically restructured over the past 40 years to understate real inflation. They've changed the methodology, the basket of goods, the way they calculate housing costs. If we measured inflation the same way we did in 1980, we'd be looking at numbers that would shock you. We're talking double digits, sustained, with no end in sight. And here's the thing about inflation that most people don't understand. It's not just about prices going up. It's about the destruction of your purchasing power, your ability to maintain your standard of living, to retire with dignity, to pass wealth to your children. Every day your cash sits in the bank earning 4% while real inflation runs at 10%, you're losing 6% of your wealth. That's not a slow leak. That's a gushing wound. But let's talk about what's really happening behind the scenes, because this is where the story gets absolutely fascinating. Central banks around the world are in the middle of the largest gold accumulation spree in modern history. The People's Bank of China has been buying gold every single month for over 2 years straight. Not occasionally, not when prices dip. Every single month. They added another 23 tons just last month. Russia's central bank, despite being under the most severe sanctions in history, continues to accumulate. Turkey, India, Poland, Singapore. The list goes on and on. Now ask yourself this question. Why would central banks, the institutions that print money, the ones who control the monetary system, be desperately accumulating a barbarous relic that supposedly has no place in the modern financial system? What do they know that they're not telling you? I'll tell you exactly what they know. They know the current monetary system is built on a foundation of debt that can never be repaid. They know that the only way out is through inflation, through devaluation, through the systematic destruction of purchasing power. And they know that when the reset comes, and it will come, the institutions holding real assets, tangible wealth, will be the ones left standing. Let me take you back to a moment in history that's eerily similar to where we are right now. August 1971. President Nixon closes the gold window, severs the last link between the dollar and gold. At the time, gold was $35 an ounce. The experts said it didn't matter. They said the dollar was strong, backed by the full faith and credit of the United States government. They said gold was a relic of the past. What happened next? By 1980, gold hit $850 an ounce. That's not just a price increase. That's a 2,400% gain in less than a decade. But here's what's really important. It wasn't that gold became more valuable. It's that the dollar became less valuable. Gold simply maintained its purchasing power while paper currency was destroyed. And we're seeing the exact same setup today, except the numbers are bigger, the debt is larger, and the consequences are more severe. The federal debt is now $34 trillion and climbing by $1 trillion every 100 days. Think about that. $1 trillion of new debt every 100 days. That's not sustainable. That's not manageable. That's a system in its final stages. Now, here's where this gets personal for you. If you're sitting on cash in the bank, you're making a bet. You're betting that the system holds together, that inflation stays contained, that your purchasing power remains intact. But the smart money, the institutional money, the central banks themselves, they're making the opposite bet. They're moving into hard assets, into gold, into things that can't be printed, can't be devalued, can't be inflated away. I want to talk about something that happened just a few weeks ago that barely made the news, but should have been front-page headlines everywhere. The COMEX, the major commodities exchange where gold futures are traded, saw one of the largest delivery requests in its history. We're talking about actual physical gold being demanded for delivery, not just paper contracts being rolled over. When that happens, when people start demanding the real thing instead of the promise of the real thing, that's when you know the game is changing. And here's the really interesting part. The ratio of paper gold to physical gold in the system is estimated to be somewhere around 100 to 1. That means for every ounce of actual physical gold that exists, there are 100 paper claims on that same ounce. What happens when everyone shows up to claim their gold at the same time? What happens when the music stops and there aren't enough chairs? We got a preview of this in 2008. Remember when the financial system nearly collapsed? Gold went from around $700 an ounce to over $1,900 in just 3 years. But this time is different. This time the debt is bigger, the money printing is more extreme, and the trust in the system is more fragile. Let me tell you about a conversation I had with a wealth manager who handles portfolios for ultra-high net worth individuals. These are people with $50, $100, $200 million. He told me something that stuck with me. He said, "My clients aren't buying gold because they think it's going to make them rich. They're buying gold because they're terrified of becoming poor." Think about that. The people with the most to lose, the ones with the best advisors, the most sophisticated understanding of the financial system, they're moving into gold not for profit, but for protection. And protection is really what this is about. Because here's the brutal truth. Your cash in the bank is not an asset. It's a liability. It's a claim on future purchasing power that's being systematically destroyed. Every time the Fed expands its balance sheet, every time the government runs another $1 trillion deficit, every time they print more money to paper over the problems, your cash becomes worth less. But gold? Gold is nobody's liability. It's not a promise. It's not a claim on future payment. It's real, tangible wealth that's been recognized as money for 5,000 years. When empires fall, when currencies collapse, when financial systems reset, gold endures. It always has. It always will. Now, I want to address something important here because I know some of you are thinking about your retirement accounts, your 401ks, your IRAs. You've got hundreds of thousands, maybe millions sitting there, and you're wondering how this applies to you. Here's the thing. You can actually hold physical gold inside a retirement account. It's called a gold IRA, and it allows you to get real, tangible, precious metals into your retirement portfolio without triggering taxes or penalties. I put together a comprehensive guide on exactly how this works. It's completely free, and you'll find it in the description below. If you've got $100,000 or more in retirement savings, this is something you need to understand. The guide covers everything: how to roll over existing accounts, what types of gold qualify, how the storage works, all of it. No sales pitch, just information you need to make an informed decision. Check it out if this is relevant to your situation. All right, back to what's happening in the markets right now, because this is where things get really interesting. We're seeing a technical setup in gold that we haven't seen in over a decade. Gold recently broke through its previous all-time high and is now consolidating above that level. In technical analysis terms, that's called a breakout and retest, and it's one of the most bullish patterns you can see. But the technicals are just confirming what the fundamentals are screaming. Look at the supply and demand dynamics. Gold mine production has been essentially flat for years. We're not finding new major deposits. The easy gold has been mined. Meanwhile, demand is exploding. Central banks are buying at record levels. Retail investors in Asia are accumulating. Industrial demand continues to grow. And now, with the approval of gold ETFs that allow institutional investors to gain exposure, we're seeing a whole new wave of demand entering the market. This is basic economics. When supply is constrained and demand is increasing, price has to rise. But with gold, it's not just about supply and demand in the traditional sense. Gold is money. It's a monetary asset. And when confidence in paper currencies declines, when trust in the financial system erodes, demand for gold doesn't just increase linearly, it explodes exponentially. Let me give you a specific example of what I'm talking about. In 2011, during the European debt crisis, gold hit $1,900 an ounce. At the time, the federal debt was $14 trillion. Today, the debt is $34 trillion, more than double. The Fed's balance sheet has nearly doubled. The money supply has exploded. Yet gold, until recently, was trading below its 2011 high. Does that make sense to you? The fundamentals are twice as bullish, but the price was the same. What that tells me is that gold has been artificially suppressed, held down by paper market manipulation, by central bank intervention, by a concerted effort to maintain confidence in fiat currencies. But that dam is breaking. The pressure has built up for over a decade, and now it's starting to release. When gold finally breaks free from this suppression, when the true price discovery happens, we're not talking about a move to 2,500 or 3,000. We're talking about a repricing that could take gold to $5,000, $6,000, maybe $10,000 an ounce. And before you think that sounds crazy, let me put it in perspective. If gold were to simply match the percentage of global financial assets that it represented in 1980, we'd be looking at gold prices well above $10,000. If gold were to back just 20% of the U.S. money supply the way it did historically, we'd be looking at similar numbers. These aren't wild predictions. These are mathematical calculations based on historical precedents. But here's what really matters for you, sitting there with cash in the bank. You don't need gold to go to $10,000 to protect your wealth. You just need it to maintain its purchasing power while your cash loses its purchasing power. That's the trade. That's the hedge. That's the insurance policy. Think about it this way. If you have $100,000 in the bank right now and inflation runs at 8% for the next 5 years, your purchasing power drops to about $66,000. You've lost a third of your wealth. But if you had moved that $100,000 into gold, and gold simply kept pace with real inflation, you'd still have $100,000 of purchasing power. You haven't made money, but you haven't lost money either. You've preserved your wealth. But the reality is, gold doesn't just keep pace with inflation. It outpaces it during periods of monetary instability. During the 1970s, while the dollar lost half its purchasing power, gold multiplied by 24 times. During the 2000s, while the dollar weakened, gold went from $250 to $1,900. The pattern is clear. When the monetary system is under stress, gold doesn't just protect wealth. It multiplies it. And we are absolutely, unequivocally in a period of monetary stress right now. The signs are everywhere. The yield curve has been inverted for months, a classic recession indicator. Bank failures are starting to pop up. Commercial real estate is imploding. Credit card debt is at all-time highs. Auto loan delinquencies are spiking. Consumer confidence is plummeting despite what the official numbers say. But here's the really scary part. The Fed is trapped. If they raise rates to fight inflation, they crash the economy and trigger a wave of defaults that could bring down the entire financial system. If they lower rates or start printing again, they pour gasoline on the inflation fire and destroy the currency. There's no good option. There's no easy way out. They're going to have to choose between a deflationary collapse or an inflationary destruction of the currency. And history shows us that central banks always choose inflation. Why? Because inflation is politically easier. It's a hidden tax. Most people don't understand it. They see prices going up and blame corporations, blame supply chains, blame anything except the real culprit, monetary debasement. But deflation? Deflation is obvious. Deflation means defaults, Bankruptcies, unemployment, social unrest. Politicians can't hide from that. So they'll print, they'll inflate, they'll destroy the currency to save the system. And when they do, when the next crisis hits and the printing presses start running again, your cash in the bank will be the first casualty. Not because the bank will fail, although some will, but because the purchasing power of that cash will evaporate faster than you can react. I want you to imagine something. Imagine waking up one morning and finding out that the Fed has announced a new round of quantitative easing. $5 trillion, $10 trillion, whatever it takes to stabilize the system. The stock market rallies. The news anchors celebrate, crisis averted. But what they don't tell you is that your savings just lost 20, 30, maybe 40% of their purchasing power overnight. Not in nominal terms. Your bank account still shows the same number. But what that number can buy, what it's actually worth, has been cut in half. This isn't hypothetical. This is what happened in Weimar Germany. This is what happened in Zimbabwe. This is what happened in Venezuela. This is what's happening in Turkey and Argentina right now. The pattern is always the same. The government prints money to solve a crisis. The currency loses value. Prices skyrocket. And the people holding cash are destroyed. Now, I'm not saying the US dollar is going to collapse tomorrow. I'm not saying we're going to see Weimar-style hyperinflation next week, but I am saying that the trajectory is clear, the warning signs are flashing, and the time to protect yourself is before the crisis, not during it. Here's something most people don't realize. In every major currency crisis in history, there's a moment when the smart money moves. It's not when the crisis hits. It's not when the currency is already collapsing. It's in the months and years before, when the fundamentals are deteriorating, but the majority still believes everything is fine. That's when the wealthy, the connected, the informed move their wealth into hard assets. And by the time the crisis becomes obvious to everyone else, it's too late. The gold is gone. The prices have already moved. The protection is no longer available. We're in that window right now. The fundamentals are screaming danger. The debt is unsustainable. The money printing is accelerating. The inflation is entrenched. But most people still believe their cash is safe. They still trust the system. They still think this time is different. But it's not different. It's never different. The laws of economics don't change. The consequences of monetary debasement don't change. The only thing that changes is the speed and the scale. And the scale of what's coming is unprecedented. We've never had global debt at these levels. We've never had central banks this extended. We've never had a reserve currency this abused. When this unwinds, and it will unwind, the reset will be historic. So here's my question for you. Where do you want to be when that happens? Do you want to be holding paper promises, digital entries in a bank account, claims on a system that's breaking down? Or do you want to be holding real, tangible wealth that survived every crisis, every collapse, every reset in human history? The choice is yours. But the window is closing. Every day that passes, every $1 trillion of new debt, every expansion of the money supply, every sign of stress in the system, that window gets a little bit smaller. The smart money is already moving. The central banks are already accumulating. The question is, are you going to wait until everyone else figures it out? Or are you going to act now while you still can? Your cash in the bank is not safe. It's not protected. It's not preserving your wealth. It's slowly, systematically being destroyed by forces beyond your control. But you have a choice. You can continue to trust a system that's failing, or you can take control of your financial future and move into real, tangible assets that have protected wealth for thousands of years. The warning signs are here. The alarm is sounding. The question is, are you going to listen?